Hello, I'm Elizabeth Tilley and welcome to The Small Caps, where we discuss the issues facing the smaller side of the market. Ahead on the program, we'll speak to the Executive Chairman of minerals explorer Diatreme Resources about progress at the company's flagship zircon project. We'll also hear why UBS analyst Clinton Wong thinks it's too early to think about domestic cyclicals just yet. But first, for a look at how the small cap space has been performing over the past month and what stocks are worth keeping an eye on, I spoke earlier to Sebastian Evans, a portfolio manager at Naos Asset Management, and started by asking him where he sees attractive investment opportunities in the sector right now.
Yeah, look, we've been really focusing on, I suppose, very stock specific. So we've been steering away from the mining services sector and the resources sector as a whole, and even to an extent some industrials. We've been heavily invested in the, I suppose, the main sectors being life sciences and biotech, and then sort of IT and telecommunications have really been the sectors for us. So really trying to play on the NBN network and the cloud, I suppose, that everyone continues to talk about. And for us, we're really looking for ways and companies that are going to grow regardless of the macro environment that's around us and the subsequent uncertainty. So I suppose in a lot of ways that doesn't pan out all the way because the market is very much a confidence-driven marketplace. But to an extent and over time, that's what we try to produce, is over time these companies will continue to grow regardless of the macro environment around them.
Sebastian, one small cap stock that's really picked up recently is the biotech company Pharmaxis. Its shares up 50% yesterday after getting approval from a European regulator to market its Bronchitol product in Europe. Is this a stock that's been on your radar?
Yeah, look, no, we bought the stock actually after it got initially rejected. It was about 3 months ago now. And I think it's that classic case where you had a company at one stage was capped at $500 million, and then at one stage afterward it was capped at sort of circa 150 million. So it's a classic case of being overvalued and then significantly undervalued. So on a risk-adjusted basis, I think the chances of them then succeeding in their appeal were much higher than what the market was anticipating, I think.
Do you think investors are just playing it safe at the moment and waiting to see what happens with the European debt situation?
Yeah, I think everyone that I've spoken to, and people much older than I have said it's probably the quietest market since the early 70s. They haven't seen the market as quiet as what it has been now. And I think you're seeing a lot of the fundies that I talk to, everyone's either convinced that they're positioned well enough anyway, or they're just of the view that they like to see some more tangible evidence of the Europeans getting their act together before they look to rearrange their portfolios to better suit the macro environment moving forward. But I think there's been so many false starts over in Europe, people aren't just willing to take that risk just yet. Valuations are awfully attractive, but I think you might get that market back in the 70s, and there's some great analysis of this, where the PE ratios, everyone expects them to go back to anywhere between 12 and 14 times, but we might be looking at PE ratios of 9 to 10 times for the next year or two, and that really does fundamentally change the value of the share market.
So how should investors be positioning themselves in the small cap space over the next 6 to 12 months?
Yeah, look, we're a little bit different to others, but we're very much a high conviction, highly concentrated portfolio. So we look at companies where we get a very intimate understanding of the business, spend a lot of time with management. So I'd recommend to investors, you really need to invest in things that you've got a little bit of value add. Don't use the scattergun approach. Really concentrate on key holdings and have larger weightings in them where you've got a much higher conviction of the investment outcome. So that's what we've been been adhering to. So we only hold 20 to 25 companies as opposed to 50, 60 or 80. And from time to time you will tend to get them wrong, but I think on a risk-adjusted basis that outside will more than offset the downside risk from one or two investments that don't play out as planned, and there'll always be those ones. So for any other investors, I'd say really concentrate on the businesses or where you feel you've got a competitive advantage and a greater understanding as opposed to everyone else, and don't tend to follow the herd in regards to mining services and just investing in businesses just because there is a macro tailwind, because you do find you're paying a higher premium. And I think a lot of the businesses that get left behind just because of a generic point of view, just like life sciences, because it is increased risk, but they do tend to get sold off a lot more viciously than the rest. And I think before the last 3 or 4 months, these sectors were the sectors that really outperformed over the last 3 years.
What small cap stocks do you think have performed better than expected and which perhaps have been underperforming following the latest round of reporting season results?
One of the standout ones that we had is Macquarie Telecom, which is a data centre play. So it's a managed data centre play, so it's very much leveraged to the cloud. So more and more people and businesses tend to be moving their servers off-site and then into data centre plays, and they get people to manage them. So instead of employing an IT person or staff or a team, they'll outsource it completely to Macquarie Telecom. So Macquarie Telecom had a great result, fantastic margins and top-line growth, and now they're reinvesting these proceeds into investing into a new data centre out at Ryde. So half their market cap was cash, and they've decided to invest these proceeds into a new data centre out in Ryde that will be established hopefully first quarter of next year. So that had a great run, obviously, into the last 3 months, but subsequently it has fallen back quite significantly, but the fundamental story has not changed, and there's no gearing and very little execution risk associated with that business. So that's one we've been focusing on. Another one we've been focusing on is called Riva Technology. So they're developing a biodissolvable heart stent. So a heart stent that obviously dissolves after its intended use. So currently they're just heart stents. You get a metal and they stay within your body for obviously until you die or until they're removed. So with this one it will dissolve after 3 or 4 years of use, and therefore any subsequent effects or illnesses that are associated with a metal heart stent remaining in your veins and arteries will be removed.
There's been a lot of talk about risk in the current market conditions, and small caps are often seen as risky investments. But you seem to think the small cap sector offers a significant upside on a risk-adjusted basis. How is that?
Yeah, look, I think it's always the way. It's leverage on the way up and leverage on the way down. But I think if you're going to play it from where we are now, you really need to focus on businesses that have a continuing business. They're not reliant on just one or two economic factors, whether it is the mining boom or something else. You really need businesses that are fully funded until they either expect first cash flow, or you want businesses that are profitable and have an increasing sales trend. So normally in markets, though, if you're expecting a bounce, there's always the leverage businesses that do tend to rise a lot quicker than the more sustainable businesses, so more the exploration companies and I suppose very early stage life science companies. But I think right now you'd really want to be investing for more of a longer term view, where you'd really want to look for a 3 to 5 year turnaround, because that's where you're really going to make most of your money, as opposed to just playing the bounces. I suppose you really want a more sustainable investment horizon.